Hi, it's Randy Herman with Keller Williams Realty, bringing you everything real estate. And today we're going to revisit mortgages. It's such an important topic. It was the first topic, but we only spent a half a show on it in the very beginning. So today I've invited Renee Guiboni. Thank you so much for coming.
Well, thanks for having me. Happy to be here.
But we always turn to experts in this field, and you're, of course, an expert.
Thank you.
So, Renee, why don't you tell us a little bit about yourself and about Cross Country Mortgage, where you work?
Yeah, so I'm with Cross Country Mortgage. I am a licensed loan originator with them. My office is based in Wilmington, Mass., and Cross Country is licensed in all 50 states. Our headquarters are in Ohio. And the company started around 2003, so we've been around for a little bit.
Yeah, how many brokers are with them? Do you have any idea?
Oh gosh, I think we're up over 500 now.
Wow.
Yeah, so there's quite a few of us out there.
Yeah, just like Keller Williams has 100 and almost 200,000 agents now.
That's huge.
Across the world. Yes, these companies just keep growing and growing.
Yeah.
For good reason.
Yes. We have a great company and an individual owner, and he has a real estate and lending background, so he gets it.
And how long have you been in the business?
I've been in the business about 7 years now.
Okay. And what did you do before that?
Before that, I was in employee benefits. I was a benefits broker in the health insurance and that kind of world.
So you know how to help people.
I do.
Good.
I do.
Okay.
That's the best part.
So why don't we jump in here?
Sure.
And you can help our viewers understand what is a mortgage.
Yeah, so a mortgage is a vehicle used to help purchase a home. Most people don't have the cash available to purchase a home outright, so a mortgage will help you to do that and make monthly payments as opposed to a lump sum cash payment.
And then you use the real estate itself as the collateral, right?
Correct.
The deed to it.
Yep.
And who lends this money?
So in my case, Cross Country Mortgage is a direct lender. So it's our money and we lend it to the borrowers.
Okay.
We will then package up a grouping of loans and we'll sell it to other investors. So as a direct lender.
I'm sorry. Who is the main investor that is out there now?
Typically it's a Wells Fargo, a Chase. Those are the bigger ones.
Do you sell a lot to FHA or to Fannie Mae, Freddie Mac?
Yes, absolutely.
Okay.
Absolutely, yeah.
Good. And so when that happens, do you still service the mortgage?
We do.
Okay.
We do. We have outside companies that do it for us, but we still service it. So when the loan gets sold or new servicing, the terms of the loan won't change. Just who's servicing it and who you write the check to every month.
Great. So what do you do now as a loan origination officer?
Yeah, so I meet with borrowers, people looking to either purchase a home or perhaps refinance their home, and talk to them kind of about their needs, what they're looking for. How long do they plan to be in the house, and what kind of funds they have available, and we try and match them up with the right program, the right loan program that fits their needs.
Oh, so the length of stay and the kind of situation they're in would affect the kind of loan that you would steer them towards.
Yes. For example, if somebody said, I'm just going to buy a condo right now, I'm single, and I perhaps will be here for 5 years. After that, I'm going to move to the suburbs, have kids, raise a family, move into a single family. If someone said something like that, I would perhaps put them into maybe an adjustable rate mortgage as opposed to a fixed rate if it's just a short-term purchase.
So I know that, I call mortgage brokers such as yourself all the time, last minute, weekends, et cetera, asking for a pre-approval letter. Do you want to explain what that is?
Yeah, so pretty important. As a realtor, I'm sure you don't want to take somebody out shopping for a house until you know what they're qualified for. Most of us have a champagne taste on a beer budget.
Oh, yeah.
So to prevent that, we will do what's called a pre-qual, a pre-approval for somebody. So we look at their income, we look at their credit.
Can I just ask you, what's the difference between a pre-qualification and a pre-approval?
So every mortgage company will have different terminology.
Right.
They basically mean the same thing. One perhaps goes a little bit deeper into the process
pre-approval.
and collecting more documents. I will always do a pre-approval. That way I know it's a good loan. I know it's a good pre-approval that I'm giving out. I will collect more documents from the borrower to assure that we have a good number as a pre-approved
So you
purchase
issue
price.
this pre-approval stating how much the bank or your company would be willing to loan
Correct.
this person. Does that mean that they get it automatically?
No, so it will vary depending on what they qualify for and what they're looking for. So when somebody is going out shopping for a home, depending where they're going to look to purchase, we include homeowners insurance and taxes in our rough estimate of numbers.
Right.
So it's an estimate. So taxes in one town may be significantly different than another town. So you may qualify for more purchase power in one town than you could in another. So the pre-approval is just that. It's an estimate until we find the house, and then we can run some true numbers to be sure that the candidate qualifies.
Okay, and we'll go into that, what's required for that. But then you help them choose a mortgage once they've found the house and get an accepted offer.
Yes.
You help them find the correct mortgage.
Yeah, and in most cases, two factors come into play there. We look at what they have for cash available as a down payment on the home, and we look at what their credit score is.
Right.
And that will pretty much determine what programs we have available for them.
Now, I know that, I always consider a mortgage broker as kind of the captain of the ship in terms of the mortgage. So do you then go on and is it you who orders the appraisal, the bank appraisal? And
Yes. Once we've narrowed it down and we have the house and they've put their offer in and it's been accepted, that's when the clock starts rolling. So we get the application to the borrower with signatures, and it will then move on to our underwriters. And at the same time, we're ordering the appraisal and we're ordering the title documents for the
Okay.
property.
And the appraisal is important because?
Well, that tells us, the lender, what the value of the property is. So we obviously don't want to lend more money than what the property is worth. And so we do an appraisal. It's an independent third party that we use to order those appraisals. The lender, I don't know who the lender or who the appraiser is. I don't know when it's
We've had
happening.
an appraiser on the show, yeah.
Oh, good, good. Yeah, so we have to be completely independent from that. They'll go out and do the appraisal and send us the report so that we know, and the borrower knows, that they're getting what they're paying for.
So this application, you have the appraisal that comes in, you put it through underwriting, and then what happens?
Then we look for a clear to close. So after we've collected all the documents from the borrower.
I know as a realtor, we're always looking for the commitment
the
letter.
commitment, yes. That's an
So
important
is that something
date.
that you issue or the underwriters?
So my
issue?
underwriter generally, once they've gone through the loan, will let me know that your loan has been approved, conditionally approved generally.
Right.
So there may be a few more documents required, but we have that commitment date, it's on the contract, and we listen to that date. That's an important date for everybody.
Yeah, and it's important for the seller because the seller wants to make sure that the buyer is actually going to get the loan, and this is the final
and
commitment.
that's the final commitment,
Yeah,
correct.
Terrific, okay. And then the clear to close, what's involved in
So
that?
a clear to close, so once we get that conditional commitment from the underwriter, there's usually a few conditions that are required. We get those documents needed and it goes into a final review with the underwriter. And ideally what we're looking for is a clear to close. And that's when all the paperwork is done, all the signatures are collected, and everyone can breathe a sigh of relief.
Right, so when it's clear to close, then the attorney set the dates.
then we set the closing date.
A walkthrough, the realtor does the walkthrough, and then we're at the closing table.
Yep, we show up to the table and bring your pen.
Okay, and yeah, and a lot of ink.
Yes.
And what do you require from a buyer in order to have proof that they can afford the house?
So there's some standard items that we require up front. That would be the last 2 years of tax returns, W-2s, If you're self-employed, there may be some other documents required as well. 30 days most recent pay stubs, photo ID, and that can vary. It can be a driver's license, it can be a passport, but those are the basics, and your bank statements. We've got to show that you have the money available.
Right. Okay, terrific.
Yep.
Excellent. And then what does a mortgage cost? I mean, aside from the actual interest that you're paying on the loan, what is a...
So there are some fees. You'll hear different terminology out there, but you'll hear closing costs, you'll hear down payments, you'll hear prepaids.
Application
They kind of all
fees.
wrap into it. Yep.
Yeah.
So we don't charge an application fee at our company, but
I've also called,
there will be
heard it
underwriting
called-
fees and processing fees, but your appraisal fee will be in there. The underwriter's fee and the processing fee. And then there will be some other fees, like for pulling your credit, there's a fee. And then we get into the attorney's fees to do the closing. So they write up the purchase and
Now,
sale
you're not
agreements.
talking about the
and
real estate attorney, you're talking about the lenders.
the lender's attorney, correct.
Okay.
Correct. So, and then your down payment, whatever that might be. So those kind of all get wrapped into one, what do you need for funds for closing? And they're sort of all encompassing.
Are those fees negotiable at all?
Unfortunately, no. No, they are what they are. Perhaps with the attorney, sometimes those can be negotiated, but other than that, it's a flat set fee for everybody.
I see. Okay. And once does this money, is this paid up front for these?
So nothing is paid up front.
Okay.
Nothing up front at our company. Once you're under contract and we order the appraisal,
Right.
that's sort of the first out-of-pocket expense associated with the mortgage. That is paid up front, but beyond that, we don't collect anything up front
Okay, it's at the closing.
at the closing.
Okay, great.
Correct.
So what are the algorithms? What are the formulas? How do you determine, once you get all this information, whether a buyer can actually afford a house?
So we're going to look at two numbers. We're going to look at a debt-to-income ratio, and we're going to look at an LTV, loan-to-value.
Okay.
So basically, how much are you putting down
Right.
will be your loan-to-value, but your debt-to-income ratio is the biggest one. So that is, we take your monthly debts,
Right.
not the total owed, just what your minimum monthly payments are. So if you have a car, if you have credit cards, student loans, we take those monthly payments and add them up,
Okay.
plus what the cost of the new home will be, including taxes and insurance.
Okay.
And we divide it by your monthly income. And typically we'll want that number to be no more than between 45 and 50%, depending which program we're going with.
Right. So in other words, 50% of your debt, right? You need to have 50% of your total income in order to afford a house.
Correct.
Wow. Okay.
Yeah.
And then the loan to value, what is that?
So the loan to value is determined by how much money you put down on a property. So if you're putting 5% down on a property,
Right.
your loan to value is 95%. So you're borrowing 95% of the value of the property.
And there are loans out there where you could just put down 3%, correct?
There are, yes.
Right.
And some that require zero down as well.
Right.
So,
So from a realtor's point of view, a seller is always looking for a better loan to value ratio, meaning a lower one. They want more cash in the deal.
Right.
Because then if a buyer, for some reason, decides to withdraw, there's more money in the...
there's more money on the table.
Yeah,
yeah,
on the table,
yeah. As the
exactly.
seller, they want to see some skin in the game, as they call it. So
That's right.
Yeah.
And that they can afford it. So
right.
absolutely. So there's a term known as PITI, right? Maybe you can explain that to
Yeah,
us.
so PITI, it's an acronym, PITI, and it stands for Principal, Interest, Taxes, and Insurance. So when we talk about a debt-to-income ratio, I mentioned the cost of the house is part of that number.
Right.
And we include everything. So that's the principal, the interest.
Principal on the loan.
Principal on the loan, yep, the interest on the loan. Taxes, so your property taxes.
Yep.
And your insurance, so your homeowner's insurance.
Okay.
And then if the loan has any PMI or MI, mortgage insurance, we will include that.
Okay.
And if it's a condo and there's a monthly condo fee, that's included in the PITI as well.
Okay. And is there a formula for that you determine?
We just add it all up. all comes in one big chunk.
Okay, good. The thing about everybody is always concerned about the interest rates. They've been fluctuating back and forth, and historically now they're still incredibly low.
Right.
I mean, I looked up this morning, I saw for a 30-year fixed, it's about 4.17,
Yeah.
which is amazingly low still.
Yeah.
And everybody tries to balance these things out or figure out, were they going to go up, they're going to go down. What are they really based on?
So it's based on the market, really. So depending what the stock market is doing and the bond market is doing, that's where our rates come from. So they will fluctuate every day.
I had heard that it's tied to treasuries, short-term treasuries. Is that
It
true?
is. It is. And sort of the layman's way of looking at it, typically if the stock market is not doing well,
Right.
then our interest rates are better. And the reason for that is people will get out of the stock market and get into the bonds instead. So that's where the fluctuation comes.
Okay, great. So what happens in terms of affordability from your standpoint if an interest rate is, let's say, 4% versus 5%?
It's a big difference. And buyers, that's one of the first things that they look at. And it's one of the only things that they really know to look at as a buyer and not in the industry. So they want to know what the interest rate is. And you can see from the numbers here that it will make a difference in your purchasing power.
Yeah, I mean, from the example I gave, based on $100,000, the difference between a 4% loan and a 5% loan monthly fee would be about $60.
Right.
Which doesn't sound like a lot, but if you have a loan of
Right.
$500,000, it's 5 times that.
Exactly.
Which
Exactly.
is
So it does add
$300.
up,
Yeah.
and so it will come into play when we're qualifying somebody and pre-approving them.
Right.
6 months ago we were closer in the upper 4s for rates, and today, like you said, it's gotten much better. And
So
we're in
people can
the
afford
lower
more.
4s, so they can afford more.
Okay.
Exactly.
And often you see that there's 2 different rates. It'll say, your interest rates and your APR. What does that stand for?
So your APR is your annual percentage rate. And really what that is, we call it the cost to do the mortgage, the cost to borrow from the lender. And so really what it's taking into consideration is those fees that we spoke about and your closing costs. Those are included. So basically they're taking all of the costs to get the loan itself and dividing it to come up with that annual percentage rate. And so really what it's used for is comparing apples to apples. So if you're out mortgage shopping and one lender says, our rates are the best and I can get you a mortgage at 3%. Well, that's great. I can probably get that for you too, but you're going to pay a lot of points. And so that's where that sort of comes into play, to be able to compare apples to apples. Because their APR on that 3% where they're offering this fabulous rate, they're going to charge you a lot of points for that. So the
lot of
cost
fees,
to
in
do the
other
loan,
words. So-
correct. The
so-
cost to do that loan
I
is
see.
going to be much higher. So to compare apples to apples, you would look at an APR rather than the interest rate.
Okay. And it also matters what kind of loan you have, how much you're paying per month, correct? I mean,
Correct.
the interest rates change.
Correct. Yep,
So-
different products have different rates.
So what is generally the lowest kind of rate?
Right now, an FHA loan will have the better rate
Okay, for a fixed
for a
loan?
fixed.
What about an
correct.
adjustable loan?
It will vary. If it's a 3-year or a 5-year, you might be okay. 7-year gets pretty close to what our typical fixed rates are.
Okay. And what's the difference between a jumbo loan and a regular loan?
So a
Conventional
jumbo
loan.
loan is when you're over a certain amount of a purchase price, and it's based by county. So in Massachusetts, we've got a bunch of different counties. Some of the higher priced counties, so like Suffolk County and Middlesex County, they've got a higher loan amount that you can go to before it becomes a jumbo loan. So anything over that county limit becomes a jumbo loan.
And what happens once it becomes a jumbo loan?
So then you get into some different requirements as far as qualifying. You generally have to put more down. We spoke about some of our programs have 0 down or 3% or 5%. Typically with a jumbo loan, you're putting 20% down.
Wow.
Yep.
Okay. Yep.
And some reserves. You generally need some reserves, and what I mean by that is some savings. It doesn't have to be in cash. Usually somewhere between 6 and 12 months worth of your PITI, your monthly mortgage payment, plus your taxes, insurance, condo fees, and that all added up. And you'll want 6 to 12 months of savings, and that can be in the form of cash. It can be in a retirement account.
But that's a requirement to get the loan.
Correct.
Oh, interesting. Okay. So we were talking about different kinds of loans. Maybe you can just enumerate some of them.
Sure. So there's a conventional loan, which typically would be a Fannie Mae or a Freddie Mac loan. We have FHA loans.
Meaning that they'll buy the loan
They'll buy
from
the
you.
loans from us,
Okay.
correct.
And they have their own set of requirements.
Correct, yes, different guidelines for different products.
Right.
And then there's an FHA loan, federal housing loan, which is also government-backed. And then we get into some of the, like a VA loan. So if you're a veteran, there's some pretty nice programs out there for veterans to purchase homes.
Yeah, I mean, it's 0 down, correct?
Yeah.
For some of those.
Yep. So they're very nice programs to help with the veterans. And then if you're in a more rural area, we have USDA loans, which also have no down payment required. And then we've got some rehab loans that we can do if you're looking to fix the home up as you purchase it.
Okay.
We can do those. And then we've got Mass Housing has some programs.
And what's the difference between an adjustable rate loan and a fixed loan?
Yep, so a fixed loan generally is either a 15-year or a 30-year mortgage, and the rate is fixed for the entire term of that loan, as opposed to an adjustable rate will vary. We can do a 3-year, 5-year, 7-year adjustable rate, and what that means is for the first 3 years it's fixed, and after that every year will be an adjustment.
And how is it determined, the adjustment?
It goes off of what the rates are. Usually the LIBOR rates will determine what the new rate is. And there's some rules depending which type of a loan.
In other words.
Correct.
Because I've seen them for coffee index and different kinds.
Yeah, but most times it's going to be the LIBOR rate. And it will vary. Every adjustable rate program will have some different terms. Most of them will adjust only once a year, and then there's limits on how much they can go up or down one way or the other.
And what's a HELOC loan?
A HELOC is a home equity line of credit. So that's where you've got some equity in your home and you want to access some of that. You can take out a second loan to access that equity.
Okay. And we've been talking before, and you said you've been doing a lot of reverse mortgages these days. So maybe you can explain that to us.
So it's a product that's been around for quite some time. Unfortunately, it has a very negative reputation due to some past rules about the product, but they've changed a lot, and it's a great product for seniors.
Why is that?
So you have to be 62 or older to use the product, and you can only use it on a primary residence. So for the seniors that want to stay and live at home, but maybe on a fixed income, you can access the equity in your home, and you can do it multiple ways. You can take a monthly income, you can take a lump sum, you can do a line of credit. So there's multiple ways to use it and access, and I call it income, but it's not income for tax purposes. So nothing to be reported on a tax return.
So you don't have to, like if you were just taking out an equity loan, you'd have to pay it back month by month.
Correct.
This way you don't, right?
Correct. With a reverse mortgage, there are no monthly payments required.
Right, so they're just cutting down your equity in the property
Correct.
month by month.
Yep.
Terrific.
Yep.
Do you have any examples of someone who's gotten a reverse mortgage?
Yeah, so we had a couple, they were on a very fixed income. and living off of Social Security and a very small pension, but they were sitting on a home that they owned outright,
Right.
and decided they figure they're going to stay in their house for 10 years, and they wanted to know the value of the house was $250,000.
Right.
And they said, we think we're going to stay here for 10 years. How much equity, how much monthly income can I take from
Right.
that? And so the calculations are based on the borrower's age and the value of the house. And in that particular case, they are receiving $1,000 a month for the next 10 years. As a nice little income, travel, do what they need to, make some repairs to the home. So for them, it was it
Kept
came
them
in
in the
handy.
home.
It kept them
Yeah.
in the home. They didn't want to have to sell the home and downsize.
Right.
And while they're still able, they're only 70, so they're not, quite ready to go to the nursing home or, move in with family. They still wanted to stay in their house, just needed
Well,
that extra
we
income.
often tell people that having a home is like savings, really,
It
and
is.
this is when you're cashing in on
Yes,
the savings.
and it's a way to access those savings through a reverse mortgage.
Terrific. Do you have any other programs that your company uses? or-
Yeah, so one of our great programs we have right now, as you know, that spring market is upon us.
Oh my gosh,
And
yes.
not a whole lot of inventory out there right now. So multiple buyers for individual properties. And we have a program where we call it our Fast Track program. And what it does is it will underwrite a borrower before they find a property. So when they do find the property that they're looking for and they put their offer in, they're going to be considered almost like a cash borrower because they've already gone through the financing piece of it.
Right.
So from a seller's perspective, we
They don't
talked
have
about
to-
waiting for that commitment and that
Exactly.
clear to close. We've already done that process beforehand. So they have a better chance at winning a bid. Maybe their bid isn't particularly the highest offer on a property, but because they've already gone through that underwriting process, they're a safer.
So does
offer.
that cut down the amount of time before they can close?
Yes. So if they go through the Fast Track program, we typically can close in 7 to 10 days
Right.
from when they're under contract.
Wow, that's incredible. And
Yeah.
how long is that good for?
So it's good for as long as the supporting documents we have. So I mentioned pay stubs that we needed and tax returns and things like that. So credit reports, so those all have expiration dates. The pay stubs, the bank statements, and the credit report all have expiration dates, and they're somewhere in the 3 to 4 month range
Okay.
that we can accept them. So
Great, great. Any other programs?
yeah, so we actually
I heard, sometimes lenders have loans, special loans for doctors.
For doctors, yes, that's a nice one. So for those new doctors where they have lots and lots of student loans, we will exclude that debt when we're qualifying a doctor for a loan, even if they're in their residency or if they're just about to begin collecting that doctor's paycheck. So some really great programs for them to get them into a home based on what their future income is going to be.
So very quickly, what is the difference between cross-country mortgage and so many other lenders?
So the big difference, you want to make sure that the lender you're working with is a national well-known company, but you also want to make sure they have the back office processes in place.
Right.
So I mentioned underwriting. So we have to process your loan and we have to underwrite your loan. So you want to make sure that those are in place and they have good processes in place. So our Fast Track program, for example, is a great option and opportunity for a buyer to work with a company that can help them to. We want to help you purchase your home, and we want to put you in the best position to do that. So.
Well, from a realtor's point of view, sometimes it can be a nightmare trying to deal with a lender and trying to get communication back, and et cetera. So having those systems, like you're saying, those processes in place can make a big difference. So we're running out of time, I'm afraid, but Thank you so much.
Yes, thanks for having me.
And maybe you can tell people how they can get in touch with you in the event that
Absolutely.
they have questions.
Absolutely. So Cross Country Mortgage, my office is in Wilmington on Concord Street, or you can reach me on my cell phone, 603-759-3465, or my office phone, 978-737-7489.
Terrific. And what about email?
Email is Renee, R-E-N-E-E, .Guidaboni, Guidaboni, at myccmortgage.com.
Great. Thanks a million, Renee.
Thank you so
Really
much,
appreciate
Randy.
it.
I appreciate it.
Yep.